Welcome and good morning. My name is Todd Millar, and I am your host for today's event. Thank you for taking the time out to join us. You know, as TEC Canada's president and CEO, I have had the privilege to work with many of you and leaders like you almost for 12 years now. And it truly has been an inspiring and transformational experience for me personally. Today's event, it's an exclusive one, available only to members. And it's great to see such an awesome turnout of both members and, of course, the chair community. So let's get to it. We are here to discuss a topic that's relevant to all of us, the economic landscape for the fourth quarter of 2023. And, of course, associated important topics that impact your business. And within that discussion, the TEC Canada CEO Confidence Index for the fourth quarter, which, of course, is a quarterly survey measuring the confidence of Canadian business leaders of small and medium-sized enterprise. And this survey was conducted from September 1st to October 5th. And we're very pleased to share it with all of you. Of course, we had 431 participants. So again, my appreciation for your active engagement. We've included the most recent CEO Confidence Index and the latest Andersen report in the chat area. You are very welcome to download those reports and share them with your respective teams. And of course, if you have any questions during our 1 hour session today, please place them in the Q&A section inside the Zoom platform. And if we don't get to your question during the time allotted, we'll make sure that we get back to Peter and get respective answers and forward them to you offline. Now, let me tell you a little bit about the man who reviews the data, provides insights, and helps us index that information with past CEO Confidence Index reports. He also delivers our Andersen economic report every month, which is available to members online at the techcanada.com or through the TEC Canada app. Both the Andersen report and the CEO Confidence Index are great resources for our tech community. So, Dr. Peter Andersen is an independent consulting economist specializing in economic forecasting. He obtained his doctorate in economics from Harvard University. Early in his career, he was the assistant chief of the Bank of Canada's research department, where he advised the governor and the Bank of Canada on economic conditions and the economic outlook. Dr. Andersen also spent several years with several major Bay Street investment dealer firms before founding Andersen Economic Research, Inc. He acts as a filter, separating the signals from the noise in order to provide clients with the useful information that they really need. So without further ado, I am very pleased to introduce Dr. Peter Andersen. Welcome, Peter. Thank you for joining us today.
Hey, Todd, thank you very much. And I want to express my thanks to everybody on the line. People out there, thank you for your time. I'm honored that you tuned in to hear what I have to say. Let's get on it. What's going on is that belt tightening. That's the name of the game. What we have is a squeeze. And the squeeze is getting tougher and more painful. It's a weaker economy. We have high interest rates and tight credit. And those things combined are really producing headwinds for everybody out there and for our members. Now, in terms of what economists say, you've heard the word recession mentioned a lot over the last year. And it reminds me of the fable, The Shepherd Boy Who Cried Wolf, because we actually are not in a recession at this point. Business conditions are worsening. There's no doubt about that. We're getting clear feedback from our members that business conditions are more difficult now. And in addition, looking ahead 12 months, a large percentage of our members think they'll get even worse. But getting back to the shepherd boy, cry wolf, okay? Do it once, do it twice, do it 3 times, cry wolf, talk about a recession. Recession doesn't come. And what happens is that people stop paying attention to the shepherd boy. And when the wolf finally comes, it's a big surprise. So what I'm saying is that the wolf is going to show up. And I think that the wolf is going to show up on the other side of New Year's as we get into 2024. And so I am concerned about the first 6 to 9 months of 2024. Now, past that point, I'm feeling more optimistic because I think that our problems will be met and they will be dealt with. And I think the uncertainty is going to slide away. So sometime perhaps about this time a year from now, we can look to better times in 25 and 26. But we're not there yet. And so that's the problem. So Colton, could you put the first slide up for me? And I'll talk to that. Economic update, Peter Andersen, here we go. So this is the thing that's the problem. This is the 800-pound gorilla. We have, I believe, upside inflation risk. Upside inflation risk. I don't think the Bank of Canada or the Fed in the United States, I don't think they're done. Now, tomorrow, Bank of Canada will have its interest rate announcement tomorrow. And the guessing is that they will hold back and they won't move with rates. But I'm saying as we look further ahead, I do think we have more to come on interest rates. And more importantly, even when we do get to the terminal interest rate peak, I don't think that rates are going to come down anytime soon. The thinking, of course, out there in the market has been, I believe, unrealistic. So many market commentators say that as soon as we get on target with inflation, rates will come down again and let the good times roll. Well, put yourself in the position of running the central bank. Once you get inflation down to where you want it, you're going to want to make sure it stays there. You want to make sure it's stable. So you don't want to prematurely lower interest rates and then have problems with inflation coming back. So that is kind of my first comment on this slide that I have up. Let me talk a bit more about it. You see the word second round? This is what I believe is our big risk right now. I believe we have a substantive, credible risk of a second round of wage and price inflation. The old word spiral comes to mind. I think that we are at risk of higher wages, and that will produce price increases, and it will produce even more pressure on wages. So higher wages, higher prices, and then higher prices, higher wages, and on it goes. So let's look at the details of this slide. We have a catch-up to the cost of living, and you can measure that in so many ways. As you go about your daily routines and go about your travel experience as we get into a post-COVID situation, you notice how expensive things are. So there is a legitimate need and demand out there for basically everybody to catch up with the cost of living. And I guess I'd say that the issue and the problem is that it's really yesterday's inflation that's driving this. It's what's happened to prices over the last 6 months, over the last 12 months, over the last 18 months. So it kind of locks in this push to catch up with expensive living costs. And one of the things that's different this time around is that there is really a very tight job market. The job numbers that we had nationally in the latest month, we had basically 64,000 jobs created in 1 month. 64,000. The number was 63,800. That was 3 times what had been expected before the number was released. So the bottom line here is that the job market is still really strong. Workers have no fear of job loss. Okay, so they're not going to pull back on their wage demands. And then you've got all of the news, what's happening with the automobile industry and the UAW in the United States. I think it's going to be a pattern setter for not just other industries, but a spillover pattern pattern setter for Canada as well. The UAW union is determined to get a big catch-up wage settlement and trying to figure out where the numbers are. The latest that I saw was an offer had been made for a 25% increase over 4 years. Now that would compounding be something like 5.75% per year compound. I understand it was turned down. So more to come here. No fear of job loss, aggressive labor wanting to catch up with yesterday's inflation. Now, the bond market has picked up on this. The bond market is a very interesting indicator because it really tells what is in the minds of bond traders, investors, and financial markets. And the inflation risk premium flows directly into bond yields. And the bond yield to watch, the one that I call the elephant in the room, is the U.S. 10-year Treasury bond yield. That is the elephant because it flows into so many other interest rates, mortgage rates in particular, but it also spills over into Canada. So that's my worry, everyone. I'm worried about a second round of inflation, this wage price spiral. And as I mentioned to Todd just a few moments ago, in Canada, we have terrible productivity performance. So looking at the macro situation, the macro economy just doesn't see the kind of productivity growth or productivity increase that will offset these higher wage and salary costs. So that's why I believe that we have upside inflation risk. And if I'm right on that, we also have upside interest rate risk and interest rates staying high for an uncomfortably long period of time. So let's shoot to the next slide. This is going to be an easier slide to look at. I'm not going to talk that much about it, not as much as I did on the last slide. These bars are monthly bars that show what Statistics Canada tells us about average hourly wages in Canada. Okay, average hourly wages, and it's a 12-month change. 12 months, current month compared with 12 months earlier. And you can see we're stuck at 5%. There hasn't been any kind of easing here in underlying wage settlements. The average from January to August was 5%, the 12-month change year over year. That was the average, so January to August. And then September comes in. Where does September come in? Exactly at 5% again. So we have a wage pressure situation. It's not being offset by productivity improvements. And these wage settlements are completely inconsistent with the Bank of Canada's inflation target. So we might see the Bank of Canada on hold tomorrow, but I think that's temporary. I think there's more to come. Let's take a look at the next slide. Okay, things really changed, didn't they, on October the 6th? When I wrote my September report, I had the date of the end of September through to October 6th on my report. That was because I was slowed down a little bit by some unexpected events at the end of September. But thanks to Paxlovid, I survived, but my report was a bit late coming out. But my report didn't cover the risk to oil prices, okay? There's a war premium now on oil prices. And 1973, hopefully that is a worst case scenario that's not going to come back to haunt us. But what happened in 1973? The Mideast War started on the 6th of October, 1973. Oil prices immediately doubled, and then they doubled again by the time we got into January of 1974. So right now, oil has bounced around. It's been very volatile. We have on the chart, got $88 for oil. Now, that was last Friday's number. Today, we're looking at just under $85 for oil. So it is bouncing around a lot as things flow back and forth with this war premium that we're seeing with this unknown Middle East war. I don't know what's going to happen. You don't know what's going to happen. No one knows what's going to happen. But the last time we had a serious Middle East war, we had a real problem with oil prices. So the reason I'm saying this is that oil could very well add to the inflation risk that's out there because of a wage price spiral. Okay. Next slide. There's the elephant. Okay. We're basically running at a 16-year high when it comes to the U.S. benchmark bond yield, the 10-year treasury. Now, why am I showing you an American, a U.S. interest rate? It's because it spills over into Canada. And if you want to figure out where interest rates are going on longer term maturities, you want to look at the United States, you want to look at the trend there, and you'll know for sure it's going to spill over into Canadian comparable securities as well. So take a look at what's going on. Take a look at that spike that we've seen. Now, 4.91% was what we had last Friday. And again, that's been a bit volatile. It's now below 490, but not much. 487 is now the quote. So if you eyeball that into the chart, you basically don't see anything different here. You're looking at 487 right now, virtually the same as 491 last Friday. So that spills over into mortgages. And because it spills over into the comparable government bond yield in Canada, it also spills over into Canadian mortgage rates. And right now, the 5-year mortgage rate in Canada, according to the Bank of Canada's website, over 7%, 7.07 is the 5-year Canadian mortgage rate. And with this kind of pressure on the 10-year bond yield and its overflow spillover into Canada, we have expensive mortgages. And we have people like my daughter who have to renew their mortgage. She has a 5-year mortgage. Now, she's lucky she doesn't have to renew that mortgage until 2025. But there are other people who have to renew their mortgages a lot faster than that. So that is an added headwind that we have for the Canadian economy. So, Todd, that is my run through on my slide deck. I wanted to keep it simple. I wanted to keep it manageable. And I said I'd only have 3 slides, and I couldn't resist the temptation. The slide.
No, Peter, that was, as much as you want to keep it simple, I mean, I'd say it's concise, and you've shared with all of our members a very clear view of our current situation. I have to go back to, by the way, I love the wolf and crying wolf, and that story really connected with me. So when we think about the wolf, and of course the possibility, or in other words, the wolf is definitely going to show up in terms of a recession. What do you think? What does that? When does the wolf show up, and what does the wolf look like?
Well, I guess what I'd say is looking at our survey, and I want to congratulate the respondents to this survey because there's so many of you that responded, and to have over 400 survey respondents, Todd, that's a big deal. I mean, this really means that the TEC CEO survey is a heavy-duty, important survey that really speaks loudly for the small and medium-sized business community in Canada. Other business surveys are nowhere near as big. The Bank of Canada has a survey of large Canadian firms, and their survey is limited to 100 responses. So we have over 400. So our results mean something. And not only that, our results are really up to date because, as you said, we didn't close our survey off until October the 5th. Right. So this is real-time information. So in terms of the wolf, what the survey is telling us on business conditions is that our members are really feeling business conditions are worse than 12 months ago. And we have a higher percentage now, a big majority, 62% of our responses say that business conditions now are worse over the last 12 months. Yeah. And you compare that with 3 months ago. Our survey 3 months ago, it was under 50. We had 47% saying conditions were worse, are worse. Now we have 62%.
Yeah, it's so enlightening, and as you point out, how legitimate our survey is relative to others. As you think about just disparity, and of course, what the survey certainly showed us was, in particular, BC, where it appears that profitability expectations in BC, are in a decreased position. Any insights as to what's going on there?
Well, that's a good point, because one of our questions, what do you think about a recession? In other words, the wolf. Okay. Yeah. What do you think about the wolf at the door? What do you think about a recession? And BC has the highest percentage of respondents who think that a recession is either a certainty or highly likely. 59% of responses in BC say that a recession is either a certainty or it's highly likely. So Quebec is a bit similar. Quebec is not quite as bad, but over 50%. Quebec is 54%. So if you go to Ontario, well, it's not as bad in Ontario, but certainly BC and Quebec do stand out as regions where it looks like the wolf is definitely got people worried.
Yeah, and any insight as to, any top of mind insights as to why that is? Obviously the survey is telling us that, but it seems like there's a bigger wolf showing up in BC, and then it gets smaller in some of the other provinces. What any insights there, Peter?
Well, I can remember years ago when I would go out to BC wearing my three-piece suit, my three-piece pinstripe suit, and I would go out to some of the financial institutions in British Columbia, in Vancouver, and also in Victoria. And the people I met with, they weren't wearing three-piece pinstripe suits. They were wearing fisherman's sweaters. And they made it very clear to me that BC marches to the tune of a different drummer than downtown Toronto and the rest of Ontario. So the resources industries, lumber, connected to the U.S. housing situation, you're looking at very painful affordability problems in the United States for home builders. So the demand for lumber is a question mark. But then the Pacific, and reaching across the Pacific to China. So it was made very clear to me when, as a Bay Street economist working for a Bay Street brokerage firm, when I go out to British Columbia and speak to the investment managers of institutions there, that BC is different. BC has got this link across the Pacific with what's going on in China, and also it's got the heavy weighting of the resource industries, lumber and mining. So
yeah, well, that's interesting, because that leads me to, I guess, another question that's come in as it relates to just the inflationary environment that we're talking about, and specifically industries. What industries have pricing power? Which don't? How do you, maybe can we expand on some more details on industries? We mentioned obviously housing, I guess, or lumber. Well,
that's a good point, because it segues exactly into our comment on BC, comparing it with the national. In terms of pricing power, it's starting to fade. However, the majority of our members, it's over 50% of our members, in fact, the number is 54%, still believe that they will increase prices over the next 12 months. Now, that's the national average. It's only 36% in British Columbia who feel that they are going to be able to increase prices over the next 12 months. So pricing power is starting to fade, and BC in particular does not have pricing power. So if only 36% are going to be increasing prices, then it's 64% are not going to increase prices in BC. 64% of our BC members are saying no.
Yeah, very interesting. I've got a question, Dr. Andersen came in. I'm going to read it here. It's a great question for you, and right on point with what we're talking about. Considering the current scenario of rising interest rates and slowed housing activity amidst the government's push and funding for more housing to support immigration and others looking for shelter, how do you foresee these dynamics evolving in the near to midterm, especially in terms of its impact on the construction sector, which we've been talking a little bit about? Additionally, how should construction companies navigate these contrasting economic signals to continue thriving and contributing to the housing objectives set forth?
Good questions. I guess I would first off say that it's not going to be like 2008. I don't think we're going to get into a situation where people are losing jobs and we have people who are defaulting on mortgages. I don't see that happening. What I think is going to happen is that we'll have more of a typical post-World War II housing problem, where basically it's a freeze. I think what will happen, Todd, is that you're going to have a freeze in terms of an affordability issue, that housing is not going to be affordable, and interest rates are definitely a big part of it. I mentioned to you that the mortgage rate in Canada is just over 7% on the 5-year mortgage.
Yeah.
But that doesn't include the extra 2%, the stress test, 2% that you have to more or less meet in order to get qualified for a mortgage.
Yeah.
If you are a first-time home buyer and you're looking to buy a home, it's not 7% you're going to pay on it is 7%. Let's get that straight. It is 7% that you're going to pay on the mortgage. But in order for the bank to qualify, you have to show that you have what it takes to handle a mortgage that's actually 2% higher than that in order to get the mortgage.
Yeah.
In order to get approved.
Mitigating risk. Yeah, I get that. Yeah.
So, but I guess what I'd say too is one of the things that's different right now is that we do not have an oversupply of housing. We have a shortage of housing in both Canada and also in the United States. So that really casts a completely different picture on what's going on. And Canada has astounding, I try to choose my words carefully as I can. And I think the word astounding really is a good word to describe our population growth. The population growth rate is 3% on a 12-month basis going through to the middle of the year. We haven't seen anything like that since 1957. And I'm not even going to ask you who won the Stanley Cup in 1957.
Please don't embarrass me.
I can't remember. It was a long time ago. So that's a big deal. That's a big deal. We have a shortage of housing. We have interest rates, mortgage rates that are just so awkward and difficult. But I don't think so I'm basically thinking there's going to be a freeze for some time. I would say the next 6 to 9 months going ahead. And so my advice to people who are in the construction business, and some of my clients are home builders. My advice is to focus on risk management. And how much are you willing to lose? How much are you willing to lose, Todd, by taking chances and being aggressive? What if you're wrong? Now, you lose the other way too, maybe. You can lose the other way by being too careful, too cautious. And you can lose if you're wrong on that decision. So where can you quantify the losses and which loss is the biggest? And right now, I would say that the biggest loss that you would get would be from being too willing to take a chance, too aggressive, too optimistic, versus the loss that you could get by holding back, being too cautious, and missing out opportunities that might happen. You won't get because you've been too cautious. I would say that the loss is bigger. It's an asymmetric loss function. Okay, how does that run you?
There you go.
It's an asymmetric loss function. Yeah.
Well, that's great. Obviously we touched on that one for sure, Peter. I guess I'm hearing conservatism, right? Not overly optimistic and not, right down the line, right? In terms of the next 6 to 9 months into 2024. Go ahead, sir.
I've lived through housing recessions before, and the word cash is king. The phrase "cash is king."
Yes,
it's something that you hear, but it's tough because in order to stay in the game as a developer and as a home builder, you have to be in the game. You just can't close down completely and take off and play golf in Florida.
That's right. Well, let me just build on the item of, we're obviously talking a lot about inflation, but other than housing, product or service categories that you think are being impacted the most by inflation?
Well, I guess the news is actually looking a little bit better in terms of where our members think inflation is going over the next year. So the 1-year outlook for inflation, given our members' thinking and our members' judgment and viewpoints, it's kind of a bit of light at the end of the tunnel here, because 40% of our members, 40%, think inflation will be under 4% 12 months out. Now, that's not a majority, but it's still basically double what we had in our previous survey.
Yeah.
So that is, in a way, good news. I'd like to see more. It still means, I think, that inflation expectations are too high. But Obviously the price pressure is the worst in industries where you have the least opportunity to bring on technology and automation. If you're able to bring on technology and automation, well, then you have a much better chance of staying competitive with your pricing.
Yeah. Well, and I was just going to say, no doubt we're going to drift into technology, because I know that AI was a topic inside of our CEO Confidence Index. Before we go there, though, just thinking about, you talked about the abundance of employment, and of course, the place of, I guess I'll call it power within the people, no fear with employees. Curious as to, along that same line of questioning, we've got a few questions coming in around, you mentioned GM and some of the strike activity that's gone on there. Obviously, the Vancouver went through port disruption with a recent strike. I don't know whether you heard or not, but I understand now the St. Lawrence Seaway is going through disruption with yet another strike activity that's imminent with, I think, Unifor on the St. Lawrence Seaway, which could have a huge impact to supply distribution and supply chain issues. Comments along that, all that language, Peter?
Well, what I'm hearing, and this is basically anecdotal information. It's judgmental information, Todd.
Yeah.
I'm hearing that the supply chain is not on a consistent trend towards improvement. And I'm hearing right now that there are glitches in the supply chain, and that you're seeing more supply chain cost and price pressure in certain areas than we thought we would see earlier. And as I said, the information I'm getting, it's kind of, anecdotal information, not necessarily a hard numerical data, but it's judgmental. So that's part of the feedback that I'm getting.
Understand. We mentioned cash earlier on. I'm bouncing, as sometimes I do with you, Dr. Andersen. I know you appreciate that. When I hear cash, and cash is king, I that certainly resonates with me. So in that spirit, where is cash best held, assuming that inflation is going to continue and the wolf's coming, and right. Where should I hide cash, or what should I do with cash?
I would try and put it in a zero risk, short-term type of deposit instrument. Treasury bills come to mind, and a treasury bill is basically a risk-free investment because it's short-term. You're looking at let's say a 3-month treasury bill, and there's not much inflation risk if it's just a 3-month maturity. And secondly, if it's issued by the government of Canada or by the U.S. government, it does not really have any risk of default either. So, yeah. Although we do have occasional risks of default, even on treasury bills. The United States had a debt ceiling fight last June. And by the way, that is kind of put to one side until 2025. But I think there's a real risk that the U.S. government could have a shutdown on the 17th of November when the continuing resolution expires. That 45-day kind of, that 45-day interval, they bought some time to get their budget passed. It looks like it's complete chaos in the U.S. House of Representatives. So.
Well, immediate impacts to us and all the members in TEC Canada that are listening in. As if your assumption is correct.
I'm sorry, Todd. Would you?
Well, with respect to the U.S. government shutting down, what would you say in November? I'm asking for a crystal ball. I know that's not a place we should go, but just curious.
Well, I guess the problem is you have to have a Speaker of the House of Representatives in order to get the legislation on the spending bills passed. And they haven't been able to get a speaker for the House. And here it is. It's going to be November the 1st, next Wednesday. And this continuing resolution expires on the 17th of November. There's no way they can get these spending bills put together and passed by the House. So is it possible to have another continuing resolution and kick it down the road for another 45 days? I really don't know. But I think right now, no one seems to be worried about it because the stock market isn't paying any attention to it. And we also have what's called the fear index in the stock market. It's the volatility, the implied volatility, the CBOE volatility index on the S&P 500. It's called VIX. And the current readings on VIX, basically, it's kind of like the Alfred E. Newman story. Who, me, worried? I'm not worried. So the stock market doesn't seem to be worried the way it should be about this pending government shutdown. It would be serious if it gets extended. And if we do have a government shutdown in the United States, I wouldn't be surprised if it does get extended perhaps into early next year.
Yeah. Hey, often we have questions that relate to CPI and the breakdown of CPI and kind of where that's at, and then I guess a related question about inflation and all the elements of inflation: housing, gas, food, services, interest, etc. What do you think's first to give? What's likely to give first as we think about the future and relating to inflation?
Well, I think that the problem is going to be when it comes to services inflation. As long as we have a tight job market, it seems to me that services inflation, not goods inflation, but services inflation, I think are going to continue to be a problem. And I think we actually need to have some fear of job loss in order to contain services inflation, thinking leisure, hospitality, travel, all of that. So that is one of my worries, that I think when the wolf does show up at the door, by the way, when we do get a worsening in business conditions, I think it's going to be an inventory cycle. And I think that companies are going to be cutting back on their inventory stockpile. They're going to be supplying the market from what's already been produced and what's sitting in the warehouse. So that's kind of so I do see falling prices for hard goods, for product that's tangible, physical product. I do see some easing back in that kind of sector. But it's the services inflation that I think I'm worried about, because the job market is just too tight.
Yeah. Well, and I know we've been talking a little bit about that, and of course, I guess in order for fear in employment to suddenly materialize, that wolf would have to be pretty big.
It's complicated because there will be layoffs. I know that our members are basically saying that layoffs are unlikely. 71% of our members are saying they're not going to lay off workers.
Right.
However, that can change. And if you do start to catch wind of some companies, and they'll be the higher profile companies, the companies that will get into the headlines. So if you start to see signs that, let's say, retailers, bricks and mortar retailers are laying off workers, or even closing down chains, closing down stores, Foot Locker, places like that, then the word gets out there. And so we don't have to have the economy slow that much, as long as there are some indications that, hey, layoffs are still there, and there's actually been a pickup in layoffs. Now, we really haven't seen that yet. But that's, I think, actually what we need to have. That's the stick that we need to have in terms of controlling services inflation. We need to see a little bit of fear, a little bit of worry about job security.
I hear you. And, obviously that number, that 70+% number, anticipating that they're not doing layoffs. Can we talk a little bit about, wage and, wage/price and the spirals that seem to be impacting TEC members? How do you see this, the whole wage and price discussion materializing in the future for our members?
Well, I guess in the first instance, you have your customers. You have retail customers that are getting squeezed because of inflation, because the wages don't go up quickly enough to get rid of the squeeze on consumer budgets right away. So that's one of the issues that our members are dealing with. And I think our members also, when it comes to their own staff and their own operations, the memories of the labor shortages are so fresh in all of our minds. And those labor shortages are still, I think, they're still kind of feeding into CEO strategy. In terms of active hiring, for example, we really don't see any cutbacks in active hiring. There has been a bit of a reduction in the percentage of members saying that they are easing back a bit in active hiring, but it's not a material change. So, Todd, that's one of the messages from our survey. The previous surveys, which have found that layoffs are unlikely and that active hiring is not really being downscaled all that much. Our latest survey continues to confirm those findings. And so I think that's really important. But what is really showing up is that so many of our members now are reporting that they're being hurt by interest rates. We have a big majority, 60% of our members are saying that interest rates at current levels, quite apart from where they might go, are a problem, are a significant negative.
Yeah. That kind of correlates into the next question, I guess, when I think about productivity and efficiency gains, drifting into the new question that we added into our CEO Confidence Index, AI, technology. Let's have a conversation about AI.
Well, AI is a new question. It was a great addition to our questionnaire, and our members have really picked up on that question, Todd. We really did get a full-throated, vigorous response. I was blown away by the high percentage of tech CEOs who indicated that AI was going to be part of and affecting and something that their companies were going to be dealing with. 68%. Now that is a big number. And because we have, what did you say, 435 responses?
Yeah, 431, yeah.
Yeah, to have 68% of our members out of that number. I mean, that is big news that AI is really being picked up. You see, before, when we asked a question on how do you respond to cost pressures, we were getting answers on things like automation. And AI is a step beyond automation. And so I guess what I'd say is our members are quick to pivot. I think that small and medium-sized businesses, they're smart, they're nimble, and they're able to pick up on challenges and opportunities a lot faster than large bureaucratic corporate organizations where you have to get approval after approval after approval. I think that tech CEOs can very quickly make key decisions on something like this. And it looks like we are. 68% of our members saying that AI is going to be a big part of their company's life.
Yeah, no, that's wonderful. And it'll be interesting to watch that one as Confidence Index go on and we get more information and insight from our members about the future of AI and how it's impacting small and medium-sized business.
Well, it's interesting, Todd. Just to continue on this for a second, one of the things I wanted to mention, I was really glad to see that very few of our members plan to substitute AI for jobs. Only 8% of the respondents indicated that they would reduce their employee headcount and use AI as a substitution. That's a small percentage, less than 10%.
Yeah.
Only less than 1 out of 10 would use AI to replace existing workers. And the majority are talking about training their existing staff on AI and also hiring new staff that are skilled with AI technology and procedures and methodology.
Yeah, very interesting. And as I said, we'll have to make sure that we keep our eye on that going forward. In one of your slides, obviously, we talked a little bit about, oil and gas, and I think you took me back to 1973 or somewhere around there. Let's talk a little bit about that. Future of energy prices. We've got, I know we've got obviously international conflicts going on, some sad stories in the Middle East. Obviously, the Russia-Ukraine battle continues. What sort of impact could all of this continue to play on Canadian industry and Canadian consumers?
Well, it's a two-way street, isn't it? In our oil and gas producing parts of the country, Alberta is definitely giving kind of a more optimistic feedback than, for example, BC or Quebec. And, Alberta feels that higher oil prices are good news. But then when you have oil consuming jurisdictions and provinces such as Ontario and Quebec, well, then it's a different matter. But that's one thing that does come through in our results, is that in Alberta, you are looking at a kind of a more optimistic spin in terms of what the economy is looking like and where we might be heading. For example, in terms of one of the key questions, talking about business conditions, looking ahead 12 months, okay?
Yeah.
We have in BC, 58% think business conditions. Now, this is the economy. This isn't the performance of the individual company, but this is just the business conditions that members are exposed to. So in British Columbia, 58%. In Quebec, 59% think it'll be worse over the next 12 months. In Alberta, that's only 34%. So that's not quite half, but big difference. So
Yeah.
Alberta, looking ahead 12 months, is definitely on a different track. And the other thing I point out is this too. In terms of where we stand now, as of today on business conditions compared with 12 months ago, 62% nationally think they're worse. Only 42% in Alberta think they're worse. So oil has to be part of that, don't you think?
Yeah. So we've got, I think, time for one last question here, Dr. Andersen. And so I'm going to give you a big one, only because you've been talking about the wolf, and I'm latching onto your metaphor, I guess.
Okay.
So when I hear our members ask the question, and I hear this often, as you say, our small and medium-sized membership is very nimble, smart men and women that are very quick. So let's talk about, as we wrap things up, how can our TEC members best prepare for the future of, call it interest rates or the wolf coming? How can they best prepare?
Well, I think common sense. And I guess the point is be skeptical because there are so many opinions out there. So be skeptical in terms of what you're reading and what you're hearing, and try to base your opinions on hard data, not what other people think. One of the problems with people in my profession, Todd, is that they work for somebody else. Quite often, economists at banks and insurance companies and major corporations, they don't want to get off on the wrong foot with their own management by coming out and saying something that the president or CEO doesn't want to hear. So that's one of the things that's a problem out there, is that there are so many opinions that are biased. And I think it's a time to be skeptical and to try and root out the biases in the conclusions and statements. And I guess, quite often, if you're in the real estate, if you're a real estate agent, if you work for a real estate company, or if you're working on Bay Street, people don't want to hear bad news. That's so many economists and so many strategists that have opinions that they share are telling you what they kind of want to have happen rather than what might happen.
You know what, Dr. Andersen, that you hit it for me when I heard research and get your facts. I think that certainly resonates with me, as I'm sure it does with our members as well. So listen, we're at the bottom of the hour. We've spent an hour together again, just riveting. Thank you, Peter. I always enjoy our time together. And I'd like to thank all of our members and chairs for attending today. And more importantly, members, thank you for supporting the survey. As Peter mentioned, it is such an incredible survey, probably one of the most engaging surveys that exists in Canada, with now 25% participation across the TEC membership, which again takes us above that 400 mark, 431 to be exact, participations, which makes this, the information very factual, to Peter's comment. TEC Canada is now closing in on 2,000 members across Canada. That's a very exciting milestone for all of us. And that's pretty remarkable, quite frankly. And as that grows, then our membership or our CEO Confidence Index will grow as well, I'm sure. I want to thank again everyone for being here. And most importantly, I want to thank you, Dr. Andersen, for participating so fully, work you do. It truly helps our tech community understand and react to opportunities in a factual way, and helps us as we prepare for the wolf. Dr. Andersen, thank you very much.
Thanks, Todd.
Thank you all.